Hi, everybody. Thank you so much for joining. We will get started in just a moment as we let a few more people filter in at the webinar link. Thank you. Okay, great. I think we've got a pretty packed conversation today, so we'll get started as people are continuing to join. Thank you, everybody, so much for joining. I'm Erin Leonard, a project manager at the Environmental Defense Fund, and I'm happy to chat with everybody today. I'm going to hand it over to Maggie to get us started.
Hi, everyone. Thank you so much for joining this webinar about EDF's global survey of agricultural finance institutions on climate and sustainability issues. Um, this survey is, as far as we know, the only global survey of ag finance institutions on this topic. And it's the second. The first survey that we did on this topic was in 2022. So today we get to show you some interesting trends in the data, and also have a great presentation from my colleague Erin that will dive deep into the data, followed by a panel with three esteemed panelists from the Bank of Ireland, Samunnati in India, and ADAPTA Climate Finance Facility in Africa. We're so thrilled that you're here with us today. I encourage you all to put questions into the Q&A. And just to quickly introduce my team, I'm Maggie Monist. I'm a senior director with Environmental Defense Fund. I lead our agriculture finance group. We are focused on advancing solutions that work for farmers when it comes to both mitigating and adapting to the impacts of climate change and generating other benefits to their communities and to their own livelihoods. And so this conversation is very timely as we look at some of the agricultural trends around the world. Um, Erin, would you like to add anything before I introduce the survey?
No, I think that was everything. Thanks.
Okay, great. Thank you. So we'll dive in and then I'll hand it over to Erin to fill you in on the results. So first, the challenge that we're facing really begins with farmers themselves. When we look at the impacts of climate change on farmers, of course, farmers are dependent on natural resources, on weather to produce their crops and livestock, and transitioning to practices and technologies and production systems that build resilience or improve sustainability, sometimes incur different kinds of financial impacts on the farm and beyond. And so, if we look at the farm economics, some of these practices and technologies incur higher upfront costs, some have ongoing costs, some have risks to crop yields or otherwise through that transition. And then the returns to those practices and technologies can be delayed or uncertain. Um, Typically, we're looking at things that are better for the farm and better for the environment and often more profitable over the long term. But getting there can be a challenge. And as farmers try to get there, sometimes they find that the loans that they use every day for seeds, for inputs, for equipment, and for land are misaligned with what they need to make this transition. In addition, in many regions of the world, access to finance is a barrier as well. So there can be significant challenges for farmers in making the shift and in finding the financing that they need that's aligned with their needs in the transition. When you take it up a level from the farm level challenges to more of a global perspective, we're also seeing big changes in trade, in crop prices around the world, of course, weather shocks, and also in the availability of public and private funding for climate smart agriculture. And so these trends and changes all make it a very volatile environment, both for farmers and for their lenders. Um, Globally, the estimated gap in annual climate finance for agri-food systems is about $1 trillion. So that really gives you a sense of the scale of the challenge and what's needed by farmers around the world. And yet, there is also great opportunity for farmers in collaborating with agricultural finance institutions. Globally, those financial institutions provide about $1.2 trillion in agricultural credit. That money is already in the agricultural system. It's already supporting farmers to grow food and other products, and it can be better aligned with what farmers need in adopting more sustainable long-term practices. Um, if just 10% of current ag finance was aligned with what farmers need to transition to climate-friendly practices, that would already surpass total global climate finance for agri-food systems, to give you a sense of scale. But it's not just about the money. Lenders also have really important relationships with their farmer clients. Some of those span years and even decades and generations. And ag finance institutions also have deep understanding of the agricultural sector. And so, as we're seeing these major shifts through the year of this past year, it's more important than ever that we understand these relationships between farmers and lenders, farmers' access to credit and availability to credit, and their ability to use those financial resources to maintain and adopt more climate-friendly practices. So that's what's at stake. I'm going to now hand it to Erin to do a deep dive into the results.
Great. Thank you so much, Maggie. Um, so to build a better understanding of how the ag lending sector approaches climate risk and sustainable lending and how we can move the sector closer to filling this finance gap that Maggie just discussed, we conducted a survey of 156 ag finance institutions from 17 countries. The respondents to the survey were primarily commercial or cooperative lenders at the senior executive level or above. And as Maggie mentioned before, this is the second time we completed the survey, with the first being in 2022. So this time around, we were able to gather some information on trends over time in the sector, which are really interesting. It's important to note that the survey is not perfectly representative of this of the sector and not fully global, but we think that there's still some really amazing insights into the sector as a whole, as well as great responses from the over 150 institutions that did fill out the survey. In this webinar, I'll be focusing on Africa, Europe, and India, but I'm going to pull in some global level findings and other regional comparisons. And for those of you on the webinar who might want to take a look at some of the data for the geographic regions represented on this map separated out, once you take a look at the full report, feel free to send me an email and might be able to get you some of that more regionally specific data. Next slide. So kind of setting the scene, agriculture is a very weather dependent and natural resource dependent business, and many ag lenders are concentrated in agriculture and concentrated within agriculture in specific regions. So, if their farmer customers can't pay back their loans due to climate related losses, this impacts financial institutions' bottom line. And therefore, increasing climate risk for farmers also means that there's increased financial risk for their lenders. Because of this, we think there's a clear business case for lenders to take action and invest in farmers' resilience. Lenders can translate some of this growing climate risk into business opportunity, primarily through supporting farmers' profitability, aligning with market demand for sustainable products, and mitigating risk within their loan portfolios. And our survey finds that overall lenders agree. they're beginning to move from awareness to action on climate. And some of the top line surveys findings from our survey are that 94% of respondents agree that climate change poses a material risk to their business, and 60% are factoring it into decision making. 87% of lenders see a clear business case for investment in sustainability and resilience, and 90% reported that they have goals or strategies in place. Of this 90%, 64% of those are increasing their sustainability efforts over the next 3 years. So, in terms of perceptions of climate risk, we found that 99% of institutions outside of the US agree that climate change poses a material risk to their organization. Most lenders also have implemented solutions to manage this risk at 89%. And the top solutions that they've reported implementing in order to manage climate risk are developing risk management frameworks, regulatory and compliance monitoring, and customer location and asset data gathering. You'll see in this chart, as well as in some of the following, that we often represent the US separately from the rest of the world. That's because across some of the categories, the US tended to be an outlier. That said, it's important to note that the US lenders who responded to our survey, the majority still acknowledge that climate change is creating risks for their borrowers and customers, and therefore their portfolios. And the majority are taking action on either measuring climate risk or offering new sustainability products and services to their customers. Within the US, we also saw between two of the surveys a lot of progress from 2022 to today, which is great. Next slide. In terms of decision making by geography, we see some different regional breakdowns here in terms of how different regions see climate change as a risk to their portfolios. We can see that Europe is leading at 55%, so the majority of institutions considering climate risk as a core decision-making factor in their day-to-day business operations. It's a little bit lower in the rest of the world, but on average, only 11% of institutions rarely or never consider climate change in their decision making, and most of these institutions are in the US. And also, sorry, missing from this slide is Africa, where 44% of institutions responded that climate change is a core factor in decision making, and no respondents said that it is rarely or never considered. Next slide. So 88% of lending institutions responded that they expect that climate change will impact their customers negatively in some way. The top answers were either through higher production costs or higher insurance premiums. And we can see on the right some of the regional distribution there. Notable in this chart is that Africa falls below the global average specifically in terms of institutions that expect their customers to see higher insurance premiums. This is potentially due to the lack of existing affordable crop insurance in Africa as a baseline. Next slide. So while 88% of respondents said that they expect some type of negative impact from climate change on their customers, about over half of lenders also responded that they see at least one potential positive financial impact from climate change for their customers. This is mainly through increased revenue or higher land asset value. Regionally, we see a good bit of variation around these expectations regarding increased revenue, which was the highest one, where we see much higher expectations around this in Australia, Africa, South America, and India, and quite below average across North America. I think that this highlights that in many regions, lenders see some upside potential from climate risk. We didn't ask why specifically, but this could be linked to opportunities for producers to capture higher market share due growing consumer demand for sustainably produced products. Next slide. So in response to institutions' growing recognition of climate risk that we looked at, lenders are putting climate and sustainability goals in place. 73% have either strategies, internal goals, or external goals in place, or plan to implement them within the next 3 years. 90% either have them in place or plan to implement them within the next 3 years. The number of lenders who currently have goals and strategies in place significantly increased between 2022 and 2025. We do see here that institutions are less likely to have external goals, with about over 60% responding that they have those, compared to over 70% having either strategies or internal goals. To us, this signals that while there may be some lender hesitancy around publicly communicating sustainability action, however, work is still happening internally. Next slide. We also asked the institutions who have either goals, strategies, internal or external strategies in place or are planning to implement them, how they are responding to changing political or regulatory pressure within their region. And of these lenders, most are continuing to increase their efforts or not changing efforts. Only 3% of respondents to this question reported that they are reducing their efforts. However, 43% of lenders did say that they are communicating differently about their efforts in response to political pressure or regulatory changes. This implies that while efforts are ongoing, lenders may not be being as public about them or are otherwise changing their communication strategies. And it's important to note that the types of regulatory pressures that we see from geography to geography are highly diverse. In some regions, we see increasing regulation or increasing government support for sustainability. And in some regions, we see those types of policies being rolled back. Next slide. So here we are looking at how institutions understand the business case for sustainability. And 87%, which is really an overwhelming majority, globally responded that they see a business case for pursuing sustainability and resilience efforts within their businesses. 51% see a business case for both sustainability and resilience, and only 8% said that they do not see a business case. Next slide. Globally, now going from understanding of risk, setting goals, to the business case, what are banks and other types of ag lenders actually doing to address these issues? We saw that 85% of respondents offer sustainability products or services, and 100% of non-US institutions offer some type of products or services. And Europe, as we look at this chart, the breakdown of what is most popular according to different regions. Europe currently leads in offering both products and services. And in India, 47% of firms offer services only, which is higher than some of the other regions. So kind of more of an emphasis on services in India. Next slide. Looking at how ag finance institutions are integrating climate considerations into their internal business processes. 85% report that they provide specific sustainability-focused products or services, and 88% report that they plan to integrate new products or services within the next 3 years. On the right, we can see that some of the ways that they're integrating climate into their businesses, such as through increased customer engagement, risk management, strategic planning, and data management, compliance, and reporting as some of the top responses there. Next slide. Looking at what lenders report as barriers to advancing sustainability and resilience, some of the two top answers here were unclear ROI or lack of a business case and limited access to financing, specifically blended finance institutions. When you break it out by region, we see that each geography is distinct in what they said was their top barrier, even though globally it's quite evenly spread across these. Blended finance sticks out in Africa and Europe, and policy uncertainty sticks out in India, and customer demand was cited as the top barrier in the US above other regions. This data shows us that institutions are facing multiple overlapping hurdles globally, but more specific hurdles regionally, and that solution should be regionally specific. Next slide. Mirroring some of the barriers identified, lenders cited that the top opportunities to build on the work that's already being done are demand support from customers, demand from value chain actors, funding from government, and investor interest in climate and sustainability topics as the top answers. And then when we zoomed further into some enablers, specifically around how lenders see opportunities to drive more collaboration across the value chain. The top responses there were through improved capability for data monitoring on environmental impacts, price premiums paid to farmers for sustainably grown products, which I think really links to the barrier identified around customer demand, and loan guarantees or other credit enhancements, which again really links to the blended finance piece that lenders identified as a barrier. Next slide. So based on the barriers and opportunities that lenders identified through our survey, it's clear that we need more coordinated action in order to maximize the potential impact of the financial sector's investment potential in sustainable ag. To bring lenders action on climate and sustainability to scale, ag lenders can do the following. Collaborate with companies across the ag value chain on blended finance in order to unlock more catalytic capital for farmers, continue to systematically address climate-related risk within their portfolios and identify more opportunities to build resilience, and deepen their understanding of farmer financing needs related to sustainability and adaptation. Lastly, it's so important to continue to demonstrate the business case for investing in resilience through research, case studies, and through collaborative conversations like this one. Thank you so much, and I will pass it back over to Maggie.
Thank you, Erin. And I want to welcome our panelists to come on the screen. Really appreciate you diving deep into the resources of this survey. We have a lot to discuss, and thrilled to introduce our panel today. I will stop sharing. Um, and as we get started in the conversation, encourage all of our listeners to put questions that you have into the Q&A box. I'm going to start with some planned questions, but then really looking forward to the questions that you have for this great group of panelists. So I'm going to start by asking each of you to share a little bit about your financial institution, your organization, and how your organization sees the business case for work on climate or sustainability topics. So Owen, I'd love to start with you.
Great. Hi, Maggie. Hi, everyone. So look, my name's Eoin Lowry. I'm head of agriculture with Bank of Ireland. We are the leading agri bank in Ireland. We bank 50% of the agricultural lending to the sector. And we have about 80,000 customers, and we've 4 billion of assets invested across the supply chain. That's from everything from farmers to farm input suppliers, processors, and co-ops. And I suppose 1.2 billion of that is at farm level, so about a quarter of it. So we've a good handle on I suppose, the requirements and the needs of the agri sector as it transitions into as a result of climate change. I suppose, how do we look at sustainability? Very much it's embedded in our strategy. And our sustainability strategy is called Investing for Tomorrow, but that's built on 3 pillars. It's about supporting the green transition, it's about enhancing financial well-being, and it's also about helping our colleagues to thrive. But the genesis of it is very much to support the transition to a low carbon economy. We've made good progress on that over the last couple of years, but definitely there is a more concerted effort needed now to grow, to collaborate with government, industry and society to reach our goals. At a very high level, before I get into specifics of Agri, we have a 15 billion sustainability lending target. That's grown about 30% year on year. And our aim is that by 2030, that target will be 30 billion. We're as I said, we're making good progress on that. We're 15 billion as of 2025, so we're halfway there, and we have met our 2025 targets. From an agri sense, it's very much sustainability is very much embedded in our agri strategy and everything that we do, and it's simply as a result of a sustainable farm is a more profitable farm and a more resilient farm. And it comes down to those essential basics of banking. And I suppose what we aim to do is, and we'll talk about this later in the conversation, but essentially what we aim to do is to make our farms more resilient over the long term, to protect our customers, our farmers, and then essentially to protect the bank. That's the core of what we do. So.
Fabulous. Thank you so much. Vivek, can I turn to you for Samunnati?
Sure, Maggie. Hello, everyone. My name is Vivek Anandan. I lead the ESG and Sustainable Finance function at Samunnati. At the outset, thanks for inviting Samunnati to be part of this discussion. Samunnati is an exclusive agri value chain financing company. We are a non-banking financial company regulated by RBI, which is the central bank in India. Our experience, we are a 11-year-old organization founded with the sole mission to enable smallholder farmer access better market. Right? We do it through financing as well as market linkages. From asset perspective, we have about 240 million USD assets. We are largely a working capital financing company, and in Indian context, since the agriculture sector has a lot of structural difficulties, challenges in terms of small landholding, small marginal farmers, it's very difficult to build a portfolio exclusively based on farmer financing, end user financing. So what we do is we finance one layer above businesses which are either supplying to the farmers or procuring from the farmers. The idea is if we provide financing to these businesses, automatically the benefits will accrue to the stakeholders, their customers. And we also do have a small portfolio where we directly finance small farmers through a middle aggregator. That's about our business model. In terms of climate financing, about 15 to 18% of our portfolio is green aligned. When I say green aligned, it is we have a sustainable finance framework certified by second party in alignment to ICMA green bond principles and climate bond taxonomy. So our focus has been to bring intentionality into building a climate focused portfolio, largely driven by availability of thematic capital. There are a lot of capital providers who wanted their capital to be deployed for a specific end use. And being a financial intermediary, our expertise lie in sourcing these assets and curating or underwriting these assets. So we act as an intermediary, as a channel for these thematic capital deployment. So by and large, we have been doing it so far. We have issued India's first green bond from the agriculture sector for 50 crores. We have accessed a couple of tranches from Symbiotics, and we have also accessed a social bond, orange bond from IX Global. So our mission is to channel these thematic capitals for a specific end use in agriculture sector. I'll stop here, Maggie.
Thank you so much. And Madleine, please introduce ADAPTA and how you see the business case for climate and sustainability.
Thank you, Maggie, and thanks for this opportunity to join the webinar. Congratulations on the report. I think it has profiled, from my background in banking, I can ratify that it has profiled very well how agri-finance institutions view this particular subject that we are discussing today. So my name is Madleine Mwithiga. I am the CEO and founder of ADAPTA Climate Finance Facility. This is a debt facility, a blended finance vehicle, where we've set up a pool of funds to provide credit and with the goal of transforming agricultural finance and supporting food security in sub-Saharan Africa. I'm based out of Nairobi. My background is actually in banking, 29 years, leading SME portfolios at Standard Chartered across Africa, 14 markets in Africa. And before that for ABSA, then known as Barclays. And so throughout my experience, I really encountered that a lot of GDP dependent, a lot of countries whose GDP is dependent on agriculture as the mainstay economic activity, there was little or no credit moving that way. There was not much data, but right now data has come out that it's about under 5% even in the best markets. And that led me to actually leave my regional head of Africa for Standard Chartered SMEs to start ADAPTA 6 years ago. We set out to build technology that actually sizes out the farm itself, what crops are being grown on the farm, and for each crop specific to the location, a credit score that spells out the risks from a climate perspective were produced in a PDF. So in a minute, in a farm location, you key in the farm location and the crop or livestock. It's also a livestock tool that's being grown or produced in the farm. And a report comes out suggesting what climate, biodiversity, soil, and water interventions need to take place. It's AI generated, but because 6 years ago when we started, there was not much leverage on that. It's also algo based with data sets from partners who helped us build that. And this was seeded by the Gates Foundation. So we worked with CGR, those who may know that umbrella institution, with a lot of data sets and indexes that come together to create a mathematical score. So how does this help? I think from my background, I'm a farmer as well. I grow herbs, sugarcane, I keep livestock, but I wouldn't even lend to myself as a small scale primary producer or a medium scale. Because apart from looking at the farmer, we do know as bankers, we know that there's another inherent risk that is borne by the farm itself as the borrowing entity. And so without the right approaches to actually size out what risk there is, and this has been the history of most financial institutions. Most other sectors, there's fast credit, and there's a lot of quick turnaround in terms of approvals. But agriculture is a bit high cost to manage, even originate, to serve, apart from actually going to try and tell what specific risks exist on the farm. So I set out to build that technology, and out of that parent company, known as ADAPTA Earth, we have created ADAPTA Climate Facility as a finance vehicle that now addresses more sustainable products, and we'll be talking more about that. How does a bank know that a farmer is resilient, and how do the banks or the financial institutions or the SACCO, the cooperative that's lending, how do their products actually then align to the cycles and the resilience that this farmer and the crop on their farm represent? I think apart from that, I'd just like to mention that it's a $50 million vehicle. We are raising funds, but my background, I handled about $5 billion of book across 50,000 clients. So we want to scale and reach about 1.5 million farmers, certify them to be climate resilient, and present them. And we are doing that. We've started. We've done quite a bit of training and adaptation training, giving curriculums to farmers and actually visiting their farms to see that they're applying what they learned in class. And we'll be talking more about that. Thank you.
Thank you. These are really three fascinating stories of how climate and sustainability topics are integrated into your businesses in a very thorough way. Owen, I want to turn back to you and dig in a little bit more deeply on the goals that you mentioned. So we saw in the survey findings that external goals are less common than internal targets or strategies. So interested to hear more about how Bank of Ireland came about creating that goal, what the internal buy-in process was like, and how you came to set that target and be able to talk about it here today.
Yeah, great, Maggie. Yeah, I suppose, look, where is the requirement for this coming from is probably important to understand as well for the audience. Primarily, it's coming from our investors, so, but not only our investors. So our policymakers are requiring banks to set out goals around sustainable lending, but also our consumers are, and ultimately consumers of food. So you have the big blue chip brands, global brands, you have the processors in those supply chains, and all of them, I suppose, requiring to set targets around climate and environmental improvement. For us, we aligned with the SBTI, the Science Based Targets Initiative, and that was a great initiative and benchmark, I suppose, to establish a set framework around how we meet our climate goals, but also align to others in our supply chain. So what we have found is that of our corporate lending customers, 28% of those have now set down their own SBT targets, which is brilliant because then we're all talking to the same language and we're all aligned along the supply chain. From an Agri perspective, I suppose we set about a target where this year we will have about 10 to 15% of all our new lending to farmers in Ireland will be sustainable or green. And that's set out by our sustainable finance framework that we established a couple of years ago. But we established a pathway for our Agri strategy called Greenfields 2030, and it was based on three pillars: understanding first and foremost, what is a sustainable loan to a farmer look like? What are the opportunities from climate change going to be? And then what does the farmer of the future look like? And I suppose we use that framework to communicate to our board and our senior executives, our chief sustainability officer and our investor relations officer, to get buy-in from the top of the organization. But we needed to develop a framework that was simple to understand, and that's why we had very clear pillars. So one was that understanding piece. Two, that was embedded in risk. So we wanted to ensure that anything that we did as a bank would reduce or mitigate risk. But thirdly, we wanted to be able to support our customers. So support our colleagues that they will be able to have better engagement with our customers, but also support our customers to better understand, because this is complex and new language for ourselves, but also for our customers. Support them in terms of their understanding. And then ultimately, we wanted to be able to reward our customers. So for providing lower risk to us through data, and we'll talk about the supports in a moment as well. But we wanted to be able to reward farmers for actions taken. So it was really important, I suppose, in summary, that we got buy-in from our senior executives. And to do that, I suppose we had to make a clear pathway of our ambition, vision, and how we would implement this.
That's great. That's really helpful. And interesting to see how methodical and bringing in all those different, both the customers you serve, internal stakeholders, et cetera, to be able to set that external goal. Madleine, I'm going to turn to you on this next question, but I'm also interested in Vivek and Owen, your thoughts. So I may ask you to pipe in after Madleine speaks on this one. So respondents in the survey reported the highest concern around unclear return on investment, limited access to blended finance opportunities, and lack of customer demand as barriers to action for lenders to take more action on these topics with their customers. Do those barriers resonate with you, or does something else come to the front of your mind?
Yeah, like I said, the report was spot on in bringing out the uncomfortable reality of the vacuum that exists between farmer and finance, but also the positive actions and the bars that are continually rising across regions. Of course, with a big difference, I see US is quite an outlier. But what we are doing is bridging that vacuum with a continuum. So the ROI aspect, the need for blended finance, and the challenges of having that stacked up to address farmers. And by farmers, both the group of smallholder farmers that we deal with, but also large and organized aggregators, because there's a growing dependence by formalized aggregators, off-takers, to actually depend on a universe of smallholder farmers for increased volumes, because they can really never satisfy the demand by their own nuclear farms. As well as, of course, the aspect of the lack of demand. I have a view about that. Is there demand? But to just respond to the ROI question first, of course, climate risks are representing a very big and core aspect of the kind of risk that financial institutions are concerned about. And when you think about right from the quality of seed, which has been a challenge in my region, certified seed, and when it is available, the cost of that, and is it affordable to the many scores of farmers that need it? And thinking about how 80% of all produced crop is coming from the smallholder farms, that's a concern. Primary production itself, crop management, livestock management, all these affect the ROI certainty. When you think about, the harvesting mechanisms, most of them are poor. And those are some of the interventions that we offer by way of curriculum. Post-harvest loss management, up to 40-45% of most crops, the staples especially, going into loss. The transport logistics and the problems with either infrastructure, whether it's power grid to sustain produce at the right levels of freshness, or the roads transporting this to table, consumer access, the price changes, affordability by the consumers. When you really look at the entire chain, end-to-end, the value chain, price changes, off-takers, right now I'm saying I'm excited to work with off-takers who are promising 100% off-take, because there's cherry picking and the farmer is left with the bulk of what maybe does not meet quality. And this circles back to the quality of seed. Yeah. So when you look at that, of course, and the report also highlights about delayed returns, and of course then the seasonality, the inherent seasonality of crops, and even livestock have gestation periods. When you pack it together, ROI indeed is a concern. And I think for us to bridge what we see, even in the report being highlighted, after farm gate beyond production, there is also the aspect of how do we give some certainty about the return on investment. And so I see against that, it blends very well into the blended finance question. Is it just the farmer at the primary production level to bear this pain of loss, or can it be shared across different stacks of capital? And, and can there be less reliance on collateral, like landed collateral? Because there is traditionally, farmers will be asked for their ancestral lands or titles to land that they don't even own. They are leasing, to try and make do. So it's really, something that needs to be addressed for that certainty to kick in, for ROI, for financial institutions to really tick up and say we are ready to bear this burden and increase appetite. We need to think about the affordability of insurance as well. Yeah, the premiums. Are they affordable to farmers? Is there parametric or at least index-based insurance or reinsurance, and incentives for the financial institutions? So at ADAPTA Climate Finance, we are looking at if the commercial bank is offering the commercial stack of capital, and below that, we come in with concessional debt, that offers less cost of the overall pool of funds, because the institution has to leverage these 3 times, 2 or 3 times. So we have a bigger pool of less costly funds reaching more farmers. But then the grants also have a part to play by way of offering first loss guarantees as a relief for the bankers, for the lenders, so that they are aware that in the event, and like I said, using the kind of platform we have for assessing early risk, in the event that there's still a precipitate risk, there is a pool of funds from which banks can scoop from. And that can be as low as 10%. Because from our trials at proof of concept, and now for the programs that we have worked in as ADAPTA Earth, before we spun off ADAPTA Climate Finance Facility, we saw risk come down from highs of 8, 10, 15% loan loss portfolio for Agri in financial institutions. That's come down to under 2% over a 2 or 2.5 year period. And so blended finance has a part to play to actually appetize and bring a bit more life back to this particular finance. Now, about demand, I really believe there's a lot of demand. It's hidden demand. You just need to go asking. There is hidden demand, and it's being represented very well by the cooperatives, the aggregators who are starting to need to depend on smallholder farmers, as well as credit unions. In Africa, we call them SACCOs, Savings and Credit Cooperative Unions. Now, there is demand, but it's not being represented well because the noise, I think there's a cause and effect factor and a cost versus margin problem for farmers. So a farmer will think, should I go for a loan? And will the high interest, because it's based on risk, will that then affect my margin? So I'd rather not. So when you really think about, a farmer is thinking about the cost of inputs as well as the margin they have to pay by way of interest vis-a-vis the profitability of the farm and produce. Again, when you think about the lenders, they're thinking high risk versus what return. So then that clouds, smoke and mirrors a bit of, oh, there's no demand, but there is demand. I'm saying this because I sat in a forum where a big DFI was saying there's no demand for smallholder finance, and I tended to disagree. I said it exists, it's just been clouded by too much risk noise, which is what we need to address.
I love that point that came up on the webinar yesterday, focused on North America, this concept. Will you put a name to it? Hidden demand. It's easy for it to look like there's no demand if you don't ask your customers, and if you're not making something that's appealing to them. And so we found that, the agricultural finance institutions that we're collaborating, when they go and ask their customers and provide them with some options, there's a lot of interest and demand. And so it's really about meeting the customers where they are. I'm interested, Vivek and Owen, if you want to get in on this conversation about barriers, are there any, maybe like one barrier that's kind of top of mind for you that you could use help solving? Vivek, I might go to you first on that.
Sure. I think I echo what Madleine said. See, one of the biggest roadblock or a barrier for a financier is there's no clear evidence on return on income on a standalone basis. When I say standalone basis, we do finance businesses, we do finance end users, but when we are financing, we don't go entirely by the unit economics of the CSA technology or the CSA product or the CSA practice, because these are all yet to be proven at a scale. Evidence are yet to be generated at a scale. So rather we go with an existing business cash flows and we play it safe, right? So the point is, unit economics of CSA technologies, CSA products. When I say CSA products, CSA inputs like biofertilizers, biopesticides, cost saving, additional income streams. So these are yet to be proven at a large scale that gives comfort for the financier to come and finance it on a standalone basis. So what are financiers doing these days? We look at the existing cash flows and take comfort. Even if the CSA technology is not going to work out, maybe the borrower will pay out of the existing cash flows. Having said that, that is where the role of a blended finance comes in. Public finance, government is providing a lot of capital subsidies to ensure that there is a viable unit economics. In some cases, they are providing price assurance. In methane compressed biogas plants, they are giving some price assurance. So in a sense, public finance is a critical aspect of blended finance that de-risks the entire financing aspect of it. Second, we being India recently got upgraded as a middle income country, because of which large DFIs don't look at India as a target country for blended finance. Uh, they don't look at it. So the blended, we are left with only the philanthropic institutions and other CSR domains, which can actually provide blended finance solution for us. So that's the reality of the ground reality here. So to summarize, yes, the biggest barrier is on a standalone basis, unit economics, return on income, whatever you call it, is yet to be demonstrated at a scale. So that's still, financials are still wary about financing on a standalone basis. Rather take comfort on some other cash flows or collaterals. So that would be my point. Yeah.
That makes sense. Eoin, how about you?
Yeah, I suppose I just come in on that. I would tend to agree. I think one of the biggest challenges is, that 1.2 trillion that you mentioned in the report, and that is to ensure that level of investment and funding continues to flow into the agri sector globally. And I think that is probably one of the biggest challenges that the agri sector faces, given the climate transition that it needs to do. We know that in many regions of the world, agriculture is the most the sector that contributes the most climate emissions, and it is the largest user from a biodiversity perspective, as a large land user, and that's particularly the case in Ireland. So I think as a sector, we must challenge how we view and progress agriculture and demonstrate that it can provide a solution to climate change and transition and support other sectors to transition as well. I suppose that was very much the approach that we have taken with Bank of Ireland in the development of a product that we have called EnviroFlex, that we have developed and had in place for about 2 years. But essentially what the backdrop to that is that we understand that farming is different, that farmers who are now going to operate in a period of climate change, they need to farm differently for various different risks. But we also need to approach how we finance farmers, because it's not as simple as put on solar panels on a roof or changing windows in a factory. It's about how they farm in the future. So they need to change how they farm. So the product that we came up with is very much, it's not for green purpose lending per se. Obviously, we do those kind of loans, but it's about looking at the sustainable action that farmer is taking and adapting that into the loan process and rewarding the farmer for sustainable action that are taken. So the rewards come in the form of discounted finance, because we're now meeting our targets because we're getting more green or sustainable lending onto our books. And we're happy to invest in that over the coming years to grow that part of it. But also the farmer gets access to lower finance capital through that. And we've partnered, and I think this is a really key point to enable and ensure that the sector transitions. We need greater partnerships and we need to collaborate more along the supply chain. So whether that's government agencies such as Borby or Teagasc in Ireland, or the co-op and the supply chain who have these reward programs in place for more sustainable production, that if we collaborate and back into those already established programs, we can provide and reward farmers through lower priced finance. So I suppose that's a really key point for me, is about collaboration.
That's a big trend that we're seeing as well, and benefits the farmer because the farmer is getting a more holistic set of incentives, both from the buyers of their products plus their finance provider, that hopefully work together and are relatively seamless, as opposed to what is often the current landscape of there's this over here, there's this over here, and the farmer has to figure out how to fit them together and then go to their lender. And that can be that's a whole job in addition to the work of farming. And so that's important both from a economic viability standpoint and also just from a, making farmers' lives easier standpoint as well.
Absolutely. And just one final point on that. I think that is a trend that you're going to see more and more across global financial institutions in the future, is greater collaboration amongst each other, but also amongst the supply chains in which they operate in.
Yes, yes. Vivek, I'm going to go back to you, and I'm seeing some questions in the chat about specific examples of products or services, and so that aligns well with the question I was going to ask you, and also with Eoin's example of the EnviroFlex program. Is there a specific example of a financing product or service that you've been involved in that you'd like to highlight for the audience?
So like I said, the current finance flows is largely towards the businesses, the aggregators,
Yes.
who are dealing with the farmers, primarily for two reasons. One, it's very difficult to build a portfolio with small ticket sizes. It takes a lot of OPEX to build that portfolio of a small ticket size portfolio. It rather somebody will finance at an aggregator level. Having said that, what we have done is we are piloting a end user financing product where we have brought in a blended finance provider who has given us first loss default guarantee, meaning uh, 15 they have given a first loss default guarantee for us to explore this domain, go and finance. These are all new innovations without clear demonstrated widely accepted unit economics. These are all risky propositions, and they are providing us these blended finance solutions to go out and finance these end users of these innovations. So that is something that we are trying out, and that will help us to understand what is the actual risk involved in these kind of new technology adoption. That's one. Second, we have availed we have accessed a lot of credit guarantees, portfolio level guarantees, which has given us guarantees, pari passu guarantees up to 40% to help us venture into these new domains where the end use or risky segments, be it climate smart agriculture innovations, be it women led organizations in the agri space. So we have accessed these credit guarantees, which has actually enabled us to go and build this portfolio. So yeah, these are the two instances where we are actually doing something to build a portfolio which is conventionally considered as risky proposition.
Thank you. That's very helpful. With only a few minutes left, Madleine, I'm going to turn to you. Interested if you'd like to highlight a financial product or service example. And also, you mentioned insurance earlier, and that's also another topic that's come up in the chat. So if there's anything that you'd like to share on that topic too, and how that relates to finance, that would be very helpful.
All right. Yeah. So very quickly, so what we are doing is building portfolios for financing by credit unions and banks, tier one banks in the region, and the top SACCOs, as well as large off-takers. And we originate from a value chain perspective, group of farmers who go through a training program. So once we size out what risks exist on their farm, based on the suggestions for regenerative agriculture practices and climate adaptation methods that are suggested on the PDF, then we train the farmer in class after pre-screening them. So they are trained, and through pictorials and videos, we want to set a demo farm, but that's in the works. But for now, what we train, then we have who we call trainers of trainers. So other model farmers who actually demonstrate how it ought to be done. And through that, our monitoring and evaluation team then comes to check implementation. And then we can say that this group of farmers have been pre-certified for lending. This is because most of the regenerative practices that we teach them are actually not cost-based. They are actually more labor-intensive than cost heavy. So by the time the farmer is going for a facility, the CPs and the covenants of the loan are actually to embed now more resilience, like irrigation equipment, and to actually now spend money where money ought to be spent. We've trained groups of farmers before who thought they needed loans to add more cattle to increase their milk production, but we teach them new feeding methods and new better cow management, herd management practices, and that already increases their incomes. So the insurance aspect we have been exploring is how do we look at affordability by the farmer so that the insurance cover also acts as collateral. Yeah? Apart from first loss and guarantees, the farmer is not asked to totally cover this loan. There are also other aspects and partnerships that can come into cover. I'm cognizant of it's at the top of the hour, but we can continue the conversations elsewhere.
Thank you so much. And you make a really important point about we can both use different finance and insurance mechanisms to reduce risk, but also through technical assistance and support, we can reduce the underlying risk and through the data that you mentioned. And those are two really important complementary approaches.
Thank you.
So I want to thank everyone again for attending. I'm going to quickly go back and show the QR code for the survey and some other recent EDF insights. Thank you to our panelists for joining us today. That was a fascinating conversation. We could have gone on for much longer. So really appreciate your insights and to everyone for attending.
Thank you, Maggie. Thanks, everyone.
Thank you. Bye.
Thank you.
Thank you to
Thanks,
the
everyone.
audience too.